week this week with the Thanksgiving holiday in the U.S., so we are going to jump right in with the two things that grabbed my attention recently. The first was a Wall Street Journal article this week via Jesse Felder noting that holdings of U.S. government debt by overseas investors declined the most in almost 2 years in September as yields on treasuries climbed from near record lows. So this was the September TIC data. Noted also weak foreign demand, some of the weakest foreign demand overall since before the financial crisis. For us, this was a very big clue about the repo rate spike. Now remember, the TIC data is published on a lag. This is September data. The repo rate spike was mid-September. And so to me, it all but further makes the slam dunk case, which we think is a slam dunk case at this point. Foreign demand weakened, and that pushed more demand to primary dealers. Primary dealers financed some of that in the repo markets. Given regulatory constraints in terms of liquidity, etc., the bottom line is that where the stress manifested was in the repo rate, in the repo markets. And so ultimately what we're talking about here is a U.S. fiscal problem intensifying, and that really the temperature gauge that showed the problem were repo markets, and the fact that we've seen a continuation and increasing of repo programs, non-QE of T-bills, all suggest that these problems continue. The second was something we tweeted earlier this week. It was a adaptation of a quote from the excellent Clint Eastwood movie Flags of Our Fathers, in which we said, if stocks fall on a sustained basis, this trade war is over by the end of the month. We make a deal with the Chinese, we give them whatever they want, and we come home. And it's, like I said, based off a really interesting quote from Flags of Our Fathers. The point here in me tweeting that quote with this adaptation as it relates to the Chinese trade war was that the relationship of stocks to both U.S. tax receipts and U.S. consumer spending growth remains fairly narrowly understood. I won't say poorly understood, but narrowly understood. And while we think stocks are probably a bit stretched near term on a number of different technical metrics, and so you could see a near-term sell-off, we still think any sell-off would ironically force an acceleration in what we're seeing the Fed do vis-a-vis the balance sheet, vis-a-vis repo programs, because it would translate quickly into economic slowdown. Any sell-off in stocks would translate in economic slowdown pretty quickly. So I'm going to jump into a few questions people dropped on the Twitter feed. First off, any chance the Fed will pause in December? If so, why would they pause, and what would be the effect on stocks and other markets? I think it's a great question. I do think there's a chance they pause in December. I think the reason they would pause is I think you've seen some modest bounce in industrial indices in the U.S., but I think the bigger issue is I think they're trying to figure out if they might do more harm than good in short-term funding markets if they keep cutting rates to zero. You already saw a pretty big flow out of money market funds in the last couple of weeks, and that could create more problems for them than it solves. In terms of what it would mean for markets, I think it could be probably positive for the dollar. It would probably be negative for stocks and probably positive for bonds. Ironically, that's probably the right short-term trade read. But ironically, I would take the opposite on each of those in terms of what the sort of 3 to 6 month outlook would be in terms of if the Fed keeps growing their balance sheet but doesn't cut rates anymore. It's very inflationary if they do that. It's it would be negative for the dollar, and it would be positive for stocks and negative for bonds. In other words, you should see the long end sell off. So that's how I would answer that. What's my take on VIX net short contracts hitting a fresh record? I haven't dug into that a lot, and so there's probably a whole number of people better than me to answer that. The only thing I would say about it is these types of things don't matter until they matter, and then it's like kerosene on a fire. So if you do get a risk off, in theory that can provide some pretty meaningful gasoline on that fire. We saw something like that back in early 2018 in terms of having large amounts of VIX short positions needing to be covered, etc. Next question. Millions of retirees have purchased variable and fixed annuities over the last 5 years, and sales continue to set records. Given all that is going on with fixed income and U.S. Treasuries being bought to monetize the debt, what's your take on outcomes for retirees over 20 years? If you're talking about a 20-year time frame, I mean, for me, the path is very difficult in the immediate term to forecast because it is so political. Over a time frame like 20 years and even over a time frame like 5 years, it's a matter of national security that U.S. Treasuries lose on a real basis and potentially see pretty meaningfully negative real rates in order to sort of make the math work for the U.S. government vis-a-vis its debt, its interest payments, and its entitlement obligations. And so for me, I would not want to be overweight any fixed annuity type of investments, me personally, over a 5-20-year time horizon. However, I want to be clear that because we don't know the full path and because it's so political, I think the optimal positioning is to have some in a number of different buckets, be diversified with a slant, depending on your investment time horizon, towards the realization of the framework that real rates have to be negative over time, over the next 5-10 years, in order to make the math work. And a negative real rate environment is not an environment in which you want to be massively overweight bonds over an extended period of time. And then the last question here regarding the Fed's non-disclosure as to which banks for which it is injecting liquidity. What's the most dangerous, most likely outcome, and when are we likely to know? So when are we likely to know? I guess the Fed said we're going to hold tight on disclosing that for 2 years, I think, if I remember seeing that properly, which I can understand why they're doing that. That's probably, it's not even probably, that's how I would handle it too if I was in their shoes, so it's hard to blame them for that. I've seen speculation, informed speculation, that maybe it's a big European bank. That's possible. I suspect, but again, there's better authorities to talk on that than me. To me, the most dangerous scenario is that the Fed doesn't do anything, because ultimately, we hear a lot, hey, the euro-dollar system, the dollar-centric system, these are the centers of global finance, and it confers all this power on the United States and on the Fed. Well, there's a flip side to that coin, and the flip side to that coin is any bank, regardless of what bank this is having this problem, whether it's a European bank, whether it's a U.S. bank, whether it's Chinese, it doesn't matter. In the dollar-centric system, it's the Fed's problem. And so to me, the biggest, most dangerous thing is that for either politics or dogma or blissful unawareness, but if the Fed doesn't do enough fast enough, that to me is the biggest risk. And I think that is really the most dangerous outcome for that. So that's going to be it for tonight. As always, thank you for joining us. If you enjoy these updates, check out FFTT-LLC.com for our tree rings, information about tree rings. We get a lot of great information or a lot of great feedback on tree rings. 10 most interesting things we see with some interesting synopses for our customers. So thanks again for joining us. Look forward to chatting soon, everybody. Have a great short holiday week. Take care.